Welcome back to another video on formations. Today I'll be talking about double and triple tops and bottoms, which are formations that can provide insight on if an asset is technically leaning bearish or bullish. Double and triple bottoms are bullish, and they're comprised of valleys that mark local bottoms in price, and a neckline, which is a resistance level formed by price swings between the bottoms. For a double bottom to properly form, price has to first decline to a local bottom, followed by an upward move before heading down again. Price must then decline again to the same level as the initial bottom before bouncing again. Thus, the formation is aptly named a double bottom. Now that there are two bottoms at the same level and a clear neckline, it's time to look for a break of the neckline. Once this happens and is confirmed by flipping the neckline from resistance to support, the double bottom is confirmed, and this indicates that the asset is leaning bullish and price will continue to head higher. This typically occurs during the transitions from a downtrend to an uptrend. Double and triple tops are the opposite and are therefore bearish. They're comprised of peaks in a neckline. Price sets 2 or 3 peaks, and similar to bottoms, the neckline sits at the level price dropped to between the two peaks. Once price breaks the neckline and is confirmed by flipping it from support to resistance, the double top is confirmed. This indicates that the asset is leaning bearish and will continue to head lower. These typically occur during the transition from an uptrend to a downtrend. Again, the same logic that applies to double tops and bottoms can be applied to triple tops and bottoms. The only difference is that there's an extra peak or valley. Let's jump into the charts and see these formations in action and look at how I leverage them for the wheel options trading strategy. And remember, none of this is financial advice, it's just my opinion. The first strategy is to use double and triple tops to identify a trend change from an uptrend to a downtrend. For the wheel, it's profitable to sell calls and puts in an uptrend, so you can imagine it would be really useful to have an idea of when this uptrend may shift into a downtrend. As an early warning, tops are great for just that. Microsoft had been in an uptrend for over a year and a half. Running the wheel here would have worked really well, but eventually all uptrends have to flip. We see here that price made 3 consecutive highs, all around $342, and between these highs, price dipped down to about $320, providing a clear neckline. By the time the second peak was in, it would have been wise to stop selling puts since there was a potential double top in play. The double top formation had one more peak and became a triple top. And finally, the neckline broke. And in the following days, price came back up to retest the neckline and was swiftly rejected, confirming that the triple top was in play. The double top formation had one more peak, making it into a triple top, and then the neckline was broken, and in the following days, price came back up to retest the neckline and got swiftly rejected. This triple top gave an early indication that price will be shifting to the downside well before it concretely did, and insights like this are exactly why technical analysis can give traders an edge when implemented properly. Also, I like to leave these necklines drawn in well after the initial break. Necklines are established levels that can come in handy in the future and can serve as support or resistance. For instance, after price came way down and then shifted into an uptrend, the neckline served as resistance before breaking through, and after it broke through, it served as support. So these levels are great to keep drawn in. The second strategy is to go long on bottom breaks and confirmation. Double or triple bottoms can occur in an uptrend or a downtrend. Regardless of what trend they occur in, they are a bullish formation when confirmed. Shopify had been in a downtrend for a couple of months. This downtrend stalled when there was a double bottom with a clearly defined neckline that had several touches. Quickly after the second bottom, price rallied past the neckline, but there wasn't a daily close above the neckline, so this would not have been a trade confirmation. This is why it's so important to wait for daily closes above the neckline and confirmation before trading a formation break. Over the next few trading days, price broke the neckline and closed above it. Also, the following day, it retested the neckline, flipping it from resistance to support. And just like clockwork, Shopify rallied 30% in under 2 months. Starting the wheel on Shopify after the double bottom confirmation would have been very profitable. Soon after this local top, there was a double bottom, which is bearish. However, this time when the neckline was broken, there was no confirmation and price rallied the next day. And this rally continued to new all-time highs. This double top fake out is exactly why I don't trade based on formation breaks until they're confirmed. And that's really all there is to it. Double and triple tops are great for identifying when an uptrend may soon be over and shift into a downtrend. And double and triple bottoms are powerful entry points to start the wheel once they're confirmed. I'll be making more videos on other type of formations like wedges and triangles soon, as well as other indicators like Bollinger Bands, so stay tuned. Like and subscribe if you haven't already, and I'll see you on the next one. Peace!